Hello, what is up guys? Eman from Peso Smart PH here. Welcome sa panibagong episode. Shout out to all the podcast listeners as well. I appreciate you all. Today, let's talk about the risks involved with investing in the stock market. Number one na gusto kong pag-usapan is opportunity cost. Opportunity cost is the foregone benefit that would have been derived from an option not chosen. That is the definition na nanggaling sa Investopedia. So, for example, if I have 500k in cash, yun yung una natin example. I decided to invest that 500k in the stock market nung nag-crash yung market nung March 2020. And dahil nag-crash yung market, dun ako na-engganyo na magpasok ng ganong kalaking pera. And I thought that I'd make some quick buck. The following month, I found out that the car that I've been meaning to purchase was on a discount, no? So let's say na 40% off the original price na around 750k, hypothetically lang. And after doing the math, the car could be mine for just 450k. So that is the opportunity cost. I bought stocks a month ago, hypothetically, noong 2020, and now I'm illiquid and my portfolio is currently in the red. So I can't really sell my positions to buy the car. That is the opportunity cost for me buying in the stock market noong nag-crash. Every decision that we make entails an opportunity cost. Another example is taking the bus or the train instead of driving. It might be more comfortable to drive to work, but it's much more expensive, especially with the oil and gasoline prices nowadays. It might be cheaper to commute using public transport, but it could be more stressful and your travel time could be longer. Opportunity cost teaches us to consider all of the alternative options before making the final decision. And we should also try to develop a bird's eye view and choose the option that you think will give you the best result or the most beneficial for you. In the end, whether you made the right choice or not, don't beat yourself up. Kasi hindsight is always 2020. It's much easier to assess and evaluate the past compared to the present and of course the future. Because nobody knows what will happen by then. Number 2 risk is volatility. Volatility represents how large an asset's prices swing around the mean price. It is a statistical measure of its dispersion of returns. Again, this definition is galing sa Investopedia. The stock market is inherently volatile because it has various market participants. We have day traders, we have swing traders, we have investors, we have scalpers, we have sentiment traders, arbitrage traders, noise traders, technical traders, copy traders, long-term investors, fundamental investors, you name it. And because these market participants want to buy low and sell high, the first rule of the stock market, the price of a single stock will be very unpredictable in the short term. Every day the prices of stocks change, and essentially no one can control and predict its activity. One way that we can deal with volatility is investing for the long term. If you have been invested in the S&P 500 for 20 years or more, then your chance of making money or having a profitable portfolio is 100%. Yes, 100%. You are essentially unbeatable or virtually unbeatable. And here we are trying to beat the market day in and day out. Who would have thought that by just investing consistently for 20 years or more, anyone can say that they've beat the market? Is it really that easy? Well, we'll see in the next 20 years. Then lastly, number 3 is timing the market. This is probably the worst enemy of any investor out there. Usually, newbies enter the stock market during hype phases, or in the middle or towards the end of the bull run. Meaning you're buying stocks at the TP top when they're setting new all-time highs. That is the worst time to invest. This is the time when FOMO is at its strongest, and all of your friends are posting insane gains, and of course, you, the newbie, wants to join in the fun. You open an online broker account, buy your first stock, and in just 1 week, you're up 10%. You ride that stock all the way until you're up about, let's say, 50%. You don't sell. Everyone says, to the moon, hodl. And after the bull run was over, you're now down negative 30%. You're a bag holder. Welcome to the club. You can't believe it. You're mad at yourself, you're mad at your friends, you're mad at everybody. And finally, your portfolio is now down negative 50%. You wave the white flag and sell all of your possessions, only to find out that after a year, that same portfolio would have been doubled. So essentially, you bought high and then sold low, which is not good. Buy low, sell high, they said. Easier said than done. So next, what can you do? First, you need to study the market. You have to educate yourself and understand how the company you're buying works. You must be able to explain to anyone why you're holding a particular security. Are you holding the stock for its yearly dividend payments? Are you a dividend investor? Are you confident with your forecast that the company will continue its profitability streak in the next 5 years, in the next 10 years, 20 years, 30 years? Read company disclosures. This is very important, especially if you're new to investing. You have to review the quarterly and annual financial reports as well. Alternatively, if you're saying that you don't have the time, you may invest passively in a broad market index fund. ETFs like SPY or VOO would be a good option for beginners. These two tracks the performance of the S&P 500, the top 500 companies in the United States. DCA or dollar cost averaging will be your strategy. You have to set a capital budget, then buy the chosen ETF or the stock that you'll be choosing every first Monday of the month, regardless of the price. You don't care about the price. You will just passively buy in the market. This will eliminate your emotions being a factor in your investment decision, because that is the number one enemy with investing, are emotions. And you'll be developing the habit of investing by DCAing or PCAing if we switch from dollar to peso. The stock market is a risky place. That's why we are rewarded for being a market participant. We're willing to take on that risk for future potential gains. The best way to manage your risk and negate it is by knowing what you're buying into. You have to understand that what you're buying is essentially a part of a business. You have to understand the nature of the game. And again, owning stock means owning a part of a business. You have to understand that businesses have good and bad years. Sometimes they're profitable, sometimes they're not. Macroeconomic factors also play a part with market cycles. For example, monetary policy, inflation, geopolitics, foreign exchange, and domestic policies affect how the market behaves. There are boom and bust cycles. What you need to remember is the stock market goes up with time, and that is proven with factual data. Businesses grow and adapt with time and technology. As the technology advances, the businesses that grow with them tends to be the most successful ones. If you stick long enough in the market, you'll become successful and you will become profitable eventually. All you need is time, patience, consistency, and of course, some capital. And na natin yung episode here, guys. Sana may natutunan kayo. And if umabot kayo at the end of this episode, thank you very much. I appreciate you. Don't forget to leave this video a thumbs up if natripan nyo yung content ko. And if hindi naman, give this video a thumbs down. If bago ka sa channel ko, click the subscribe button and ring the notification bell para wala akong miss out sa mga uploads ko every single day. You may also follow me sa mga social media platforms ko. I'm on TikTok, Facebook, Instagram, and Twitter at MNPSPH. Thanks again for watching and listening, everyone. Stay safe. I'll see you on the next episode. Always remember, be Peso smart.